Welcome to Eggs Invest podcast series, where we explore strategies for successful property investment in the UK market. And today, we're delving into key insights about maximizing returns, understanding tax implications, and the importance of diligent planning in your real estate journey. Whether you're a seasoned investor or just starting, there's valuable information ahead. Let's jump right in. Let's start with strategies for maximizing returns across different real estate asset types in the UK. Property investment is a robust strategy for wealth growth, attracting individuals and institutional investors alike, with its potential for long-term value and profitable returns. At the heart of this investment approach is the essential concept of return on investment, or ROI. Now, understanding ROI isn't just about considering immediate financial gains. It's also about appreciating sustained growth over time, especially in the context of luxury and eco-friendly real estate. In the UK, specializing in luxury firms or eco-friendly apartments, focusing on restoring Grade 2 listed buildings with advanced sustainable technologies can ensure a profitable and sustainable real estate investment. Recognizing the importance of ROI is pivotal for anyone venturing into property investment. It's not just about the initial acquisition, but also the ongoing value growth, the income from rentals, and the potential for long-term capital gains. Now that we've laid the groundwork for understanding returns, let's shift gears and explore the specifics of understanding the factors that affect ROI in real estate. Return on investment is a critical metric for investors in understanding the profitability of property investments. Essentially, ROI calculates the return you receive on an investment relative to its cost, which is fundamental in gauging the efficiency of your real estate investment. In this field, significant capital is often at stake, so comprehending ROI becomes indispensable for making those informed decisions essential for sustainable wealth growth. Having covered the foundational aspects of ROI, let's discuss a crucial cost to consider when purchasing property: stamp duty. As a home buyer in the UK, whether you're a first-time buyer or a seasoned investor, you're required to pay stamp duty on properties priced over $125,000. However, there is a silver lining for first-time buyers, as they can avoid this tax on properties below $300,000. For properties priced between $125,001 and $250,000, a stamp duty rate of 2% is applied. This rate increases to 5% for properties priced from $250,001 to $925,000, and further increases to 10% and 12% for progressively higher property values. It's essential to note that these rates apply to your primary residence, and different rates apply if you're purchasing additional properties. Now, let's shift our focus from costs to considerations regarding tax implications and due diligence in property investment. Tax analysis in property investment is crucial. If a property is acquired, stamp duty land tax, or SDLT, becomes payable based on the purchase price. This is where some investors opt to buy special purpose vehicles, SPVs, holding real estate to potentially save on SDLT. Although SDLT does not generally apply to the acquisition of an SPV, due diligence remains essential. Understanding the base cost of the property helps determine taxable gains upon sale in the future. Next, let's take a look at how to calculate rental yields and the types of returns investors should be aware of. So, what is rental yield? It's a vital financial metric used to calculate the annual rental income as a percentage of the property's market value. This straightforward calculation is immensely helpful for investors who want to determine the profitability of rental properties. Typically, a good rental yield percentage is considered to be 5% or more, although this can vary based on location and property type. High-demand areas like London might yield lower rental returns, but may appreciate capital value over time. As we wrap up today's episode, remember that maximizing returns in real estate requires strategic thinking about ROI, understanding tax implications, and calculating rental yields effectively. Engaging in thorough due diligence and staying informed about changes in the property market can greatly enhance your investment journey. Thank you for tuning in to this episode of Maximizing Returns in UK Real Estate. Be sure to subscribe for more insights and feel free to share this podcast with fellow investors looking to maximize their returns. Happy investing. For any questions or topics you'd like us to cover in future episodes, reach out on our social media or website. Until next time, take care and stay informed.